Hey there, everybody. Good morning, good afternoon, good evening, depending on where you guys are at. I hope y'all are having a wonderful Wednesday. Hey there, Lorna, Mirza, good to see y'all. Carol, you watched your Iron Condor video. Um, Question: Would 4085, 4110, 4150, 4175 count as a short sandwich? Could I lose money if it went above or below either long strikes? We can certainly take a look at that. Is there a certain expiration that you're looking at that for? If so, we can pop it up here on the chart together and walk through the risk versus reward parameters and everything like that. Hey, Alex, Earl, good to see y'all. Hope you guys are having a good trading day too. As we get started here, and certainly, Carol, let me know about that expiration you're looking at, and we'll pull it up. But currently, right now, SPX, as we can see from an intraday chart perspective, is still just stuck in chop. So you're thinking of doing it yesterday. Is it going to be for Friday's expiration that you're looking at it for? Were you trying to give yourself a longer time frame? Just curious. But if you weren't looking at a specific expiration, we can always just pick one and pull it up on the option chain. But overall, I don't think an iron condor is necessarily a bad strategy to go with in this current market environment until it proves otherwise. And let's talk about why that is. So we can see here from an intraday chart perspective and from a daily chart perspective that we have been stuck in consolidation. We haven't really been able to break above from a bigger picture point of view for the last couple months. We haven't broken above 4200 on the one side. That actually has been the top of resistance from a yearly perspective too. And shorter term, we haven't broken below 4050. That's kind of been the main level of support. You can see that's right where the upper and lower Bollinger Bands are basically trading at as they trade parallel, almost looking like train tracks. During this consolidation, we've had momentum reset towards the zero line. We've had a consolidating signal on the compound breakout tool. We have a beautiful daily squeeze building up, but we don't have any clue as of yet to which way the squeeze could fire. If we start to fire to the upside, it would certainly, at the very least, allow us a retest of 4,200, if not a potential break of that weekly resistance level, and to get us going back into a bullish trend again. If, however, though, we stall, right, and we start to see a pullback kind of move, it could actually be that the squeeze fires to the downside and brings us back down into some of these bigger levels below us, like 4,000, or potentially all the way down into 3,800, which has been the main support level of this year. The overall year even has been trading in consolidation. We started at 3,800, worked our way up towards 4,200, stalled, reversed back down to 3,800, tested that held as support, bounced back up again to 4,200, and now that's currently where we're starting to flatten out at. From a shorter time perspective, as we zoom in here, you can see for the past couple weeks going into this week that really 4150, 4140 has been acting as a price resistance level, and 4100 has been acting as a price support level. And we haven't really been able to break out of this 50-point range, which is why I think Carol has the right idea in thinking that things like iron condors could work out and benefit well in this market environment. Like I said, at least until we get a catalyst that can actually move the market. Now, we do have quite a few things from an economic data standpoint that come out tomorrow. For those of you who joined in on the live session with Joe and I earlier, that was something that we talked about where we kind of asked each other, do we think that that could be a big enough catalyst to move the market? And I think both of our opinion was no, probably not, or at least I know that's what my thought process is. We do have Powell also speaking on Friday. Now, to me, I am not anticipating that to be a big market move either, unless he says something that is truly unexpected from what the market is considering. And the reason why is because back here, when we actually had the Fed data released, when we had another rate hike, when there was talks about potential rate cuts and whether or not that would happen this year, all of that did see a pickup in the daily ranges. but it didn't actually break us out of this consolidation. Even when we put pressure both on the upper and lower Bollinger Bands, you can see that the Bollinger Bands remained completely flat in that daily perspective. And when they remain flat and the underlying price puts pressure on it, that's usually a good sign that they're not anticipating a break either lower or higher. They are anticipating that those levels are going to continue to hold and that the underlying price will respect it and bounce back in the other direction. And that's exactly what we are seeing occurred, right? We put pressure on that lower Bollinger Band, the Bollinger Bands remained solid, holding on. And then we got a reversal and a bounce back up into the current consolidated range that we're in now. From an intraday perspective, we have seen arguably a little bit of movement this morning in regards to the price bars, but we're still not breaking that range and we still overall have a pretty small daily range. Certainly, we can compare it to the ranges that we had last year. You can see we got a little bit of selling, started to pull back. It did look like it was going to try and maybe put some more pressure to the downside, could have gotten us to 4,100. But as you can see, we immediately stalled right around 4,113 for the lows today, bounced right back up into the 4,125 level. We chopped there for a bit. Then we got a bit of a spike, like a 1 minute spike here, taking us up to 4,135. But the price bars immediately gave that up. Notice how even though the Bollinger Bands are starting to open up on the 10-minute chart to give us a little bit of that bullish bias, and here for you guys on YouTube and Twitch, let me make that bigger so you guys can see. So on the 10-minute chart, we are starting to see the Bollinger Bands open up, like they're anticipating that move higher. But notice the 5-minute chart. The 5-minute chart had direct pressure of this bar, trying to push things to the upside. And the Bollinger Bands actually still came down to meet the price. So that's already a clue that they're really not, at least as of right now, anticipating a break of that level. Now, the 5-minute chart, of course, is pretty easy to switch around, right? Because it's a much smaller time frame working in smaller increments. So it's easier for that to ebb and flow. But just the fact that it put that pressure on the price and said, no, I'm really not thinking you're going to get above this level, to me just shows how choppy this market still is. And certainly when we look at it from an hourly perspective, you can see the lower Bollinger Bands actually coming up to meet the price now, the upper Bollinger Bands remaining completely flat. And so at this point, they're really not anticipating a break in either direction either, as we just continue to consolidate. Our moving averages recently have been all on top of each other on the hourly time frame, which is a good sign that you're in consolidation, right? When it looks like your kid's spaghetti and it's all mixed around and it's not a nice clear bullish trend or a nice clear bearish trend, that is usually a sign for chop. And it doesn't mean you can't play chop, but you need to be mindful of how to play it. You either look to play from one level into the other. So if you're at support and things look like they're holding, you use that as a buy opportunity short term to play up into resistance. And then if resistance looks like it's holding, you use that as an opportunity to take profits on that bullish trade that you had. And if you want to be a little bit more aggressive, you then look for a bearish trade to play back to the downside on, to play back into support levels to see if those hold. Um, Overall, it does look like things are attempting to bounce higher currently, right? We do have a little bit of bullish momentum here. We have a bullish signal on the compound breakout tool. So maybe that could take us up towards the 4140 range. When we zoom out here on an hourly chart, you can see how these price bars, really since about the 5th of May, have continued to test the 4140 range. Sometimes they break a little bit above it, but on the close and open of all these bars, basically 4140 has continued to hold as a price resistance. That right now to me is kind of the top of the range. And if we really start to break and close above those levels and stair step up, then we might get a little bit more of a bullish trend going. Otherwise, I would only be looking to play into that level. And if you see any sort of stalling at that level, take the quick win and potentially look at a reversal trade to play back to the downside. The other way, of course, to play this kind of consolidation is what Carol was mentioning earlier in the session here, which is to play things like an iron condor. So let's just go ahead and set up the iron condor with the strikes that she was looking at. Let's just go with Friday's expiration. All right, will give us a little bit of time to still have the theta decay work in our favor while there's still some option premium. So Carol was looking at the 4150, 4175. So that's a 25-point width spread on this side. And then she was looking at the 4110, 4085, which is also a 25-point spread on the other side. And right now that's about for Friday's expiration. Keep in mind the weekly expiration, not the AM, because it is a monthly expiration this week. Right now that's showing about a credit of 1120 and a risk of 1390. So it certainly doesn't have a bad premium amount to it. But personally, I am not as big of a fan of this risk versus reward scenario myself. Usually, when I'm looking at iron condors and iron flies, I want the profit potential to be bigger than the risk, like I do on the majority of the trades that I open, or I at least want them to be even. And this one's close to being even. It's about 260 point $60 difference, right? On the a little bit heavier on the risk side than the profit potential. But usually I would prefer it to be just a little bit more even. So one way you could go about potentially reducing the risk and bringing that so they're closer together is just bumping up your long strike. So instead of doing a 25-point spread, you might consider a 20-point spread. That brings your difference a little bit closer together. So instead of a $260 price difference between profit potential and risk, you now have a 960 profit potential. So our overall profit potential did get reduced, but so did our risk. You can see our risk dropped down to about 1050. So here we only have about $100 difference between price between our max profit potential and our max risk. So at least in regards to it being a bit more even on the risk versus reward, I certainly prefer that a bit better than the 25-point spread personally. In regards to levels, I certainly think 4150 is a good level to be at for this week. The ATR trailing stop is right around 4147, 4148. Like I mentioned, 4140 has really been a big price level for this week too. So I think that puts it at a nice psychological level to try and hold it. 4110, I don't think is a bad spot to play to the downside. However, we did see a little bit of pressure put on that side yesterday going into the close in like the last 15 minutes. We started to get some directional selling that brought down the market. And in turn, that's where we closed is right around, I think actually 4109, but right around 4110 is where we closed at. So I don't think that's a bad spot, but just keep in mind could cause a little bit of pressure there if you're looking at this trade idea. Recently, actually, in the mastery account, I did a trade for tomorrow's expiration. So I'm happy to show that to you guys here. And for tomorrow's expiration, I also did an iron condor. I did a much smaller spread width, mind you, to keep my risk controlled. But I went with 4150 on the call spread and 4105 on the put spread. So it gives me just a little bit more of a buffer on the put side. If we roll down, it keeps my short strike at 4140. So I'm really looking for that price level to trying to continue to hold. And as long as we continue this chop going into tomorrow to where it's more of a non-event like we've seen the past week, 2 weeks, then theta decay should really work in my favor overnight on this to where I can more than likely scalp it tomorrow for some sort of profit. We did a similar trade to this in the mastery yesterday and to today. And I scalped it for a quick win this morning. Certainly, the mastery folks already know, but if you held it a bit longer, you definitely could have gotten a much bigger profit than I did. So well done if you stayed in the trade. But I think this is a good way to play the market, right? Because it allows you to take advantage of the consolidation that you see. It benefits from theta decay rather than having that theta decay hurt you on a more directional trade. Meaning, if, for example, we were looking to buy in for a call here to play for a bounce and it took forever for that bounce to occur, Well, a long directional call, especially if it's out of the money, it's going to start getting hurt by theta decay. The value and that option premium that is associated with that strike is going to lose value the more time it takes for that move to occur. Whereas with credit spreads, which is basically what creates an iron condor and iron flies, they benefit from chop. They love chop. As long as that short strike's out of the money, the theta decay then is actually favorable to your trade and taking off the premium of those options. And in turn, that's what allows you an overall profit on that strategy. So I, like I said before and this morning, I really would not mind to see the market start to break one way or another. I am much more a directional trader at heart. So I would love to see a direction start to occur. But until it proves that it's trying to break one way or the other, I have to play with the charts and technicals are telling me, which at this time is consolidation. So until it proves otherwise, those are the strategies that I will be likely sticking with at this point in my trading account. And then Carol's asking, what happens to the iron condor when the width between the short strikes gets bigger or smaller? Good question. So let me pull up the option chain here again. So back to, for example, the trade that you were looking at, right? Let's just go with the 20-point spread here. So if we were looking at something like this for Friday's expiration, what happens with the iron condor when the width between the short strikes gets bigger is you decrease on profit potential, right? So let's just move this down several points, still a 20-point width spread, right? Same width. But when we move them further away and we make the width between the two short strikes greater, it basically reduces your profit potential and increases your risk. The reason why it does this is because you're basically giving more room for the underlying price to trade in. So there's a higher probability that this trade would end up working out because it now has 60 points of move that the underlying price of SPX can move between 4,100 and 4,160 to still allow for that max profit potential versus the short strikes that you were originally looking at, the 4,150 and 4,110, for example. Well, that's only giving you about 40 points of range for the underlying price to move to still allow for that max profit potential. So the further out you go, it does reduce your overall net profit, but it also gives you a higher probability of the trade working in your favor. The downside, of course, is that by reducing your profit potential, you are also increasing the risk on the trade. So no matter what, as I always tell you guys, you have to be okay with the capital risk that you hold out there. If this is not a risk that you are okay with, then I would not be putting on this trade because let's say PAL does move the market, right? Or let's say the numbers tomorrow come out better than what you anticipated and we get a really strong move up or down to where all of a sudden your credit spread, which you want to see remain out of the money, all of a sudden we find ourselves in the money on. Well, if that's the case, then you have to be okay accepting that possible risk on the trade idea, right? So that's the downside of moving your strikes further out is that it typically increases the risk, but it also gives you a better probability that it will work. If you bring your short strikes closer together, right? And let's say we do something like this and still do a 20-point width spread, then you increase your profit potential and you reduce your risk, but now you have a much smaller range for the underlying price to move to be able to benefit from that max profit potential. So the plus side to this is your risk gets smaller. The downside is you really don't want to see any sort of volatility occur to push the underlying price into the money, either above 41.40 in this case or below 41.20. So that's the pros and cons to doing iron condors where the short strikes are either close together or farther apart. You could, of course, also consider an iron fly. This was one of the things I was actually pricing out earlier this morning to see if I wanted to do myself. And when I did this, I was pricing out 41.25 for the pin, and I was looking at a 15-point width spread, so 41.10, 41.40 as the wings. Now it doesn't look too bad because we've bounced a little. But it's showing you about a $13 credit, $2 risk. Now that's not a bad risk versus reward. But of course, to get the max profit potential, you need the trade to close right at 41.25. Otherwise, the ideal situation around an iron fly is that it just hangs out here. You don't necessarily anticipate the max profit potential, but because it's such a small risk, you do still have a range that the price can trade in to allow for theta decay to still work in your favor and give you some sort of profit on the trade. You still don't want to see the underlying price exceed your long strikes, right? Your bought to open strikes, which in this case would be 41.10 or 41.40. So you don't want it below 41.10 or above 41.40 because then you'll still incur the full risk around this trade. But the plus side to iron flies is it does allow for a much better risk versus rewards scenario typically, to where you have a little bit more flexibility to play off that premium. It also, on the downside, usually takes a bit longer for the theta decay to work in your favor because your short strikes are sharing the same strike level versus an iron condor where the short strikes are further apart and they don't share the same strike. That theta decay will usually work a lot more quickly in your favor because you could be trading, for example, right at 41.25, and both of these are out of the money to where that theta decay is really working a lot more quickly versus at the money strike level, like you might see here, for example. So I hope that kind of answers your questions, Carol, around that. And yes, you can technically lose money you'll definitely lose money if it goes above or below your long strikes. To figure out your break even point, for example, on this iron fly, just to keep math simple for myself, on this 15-point iron fly I was talking about here. And the same thing is true with an iron condor. The break even point is your risk. Oh, did not mean to do that. Sorry, guys. Is your risk off of your short, your put and call long strike. So for what I mean by that is 41.40 minus $2, because that's your risk, $200. So that's $2 per contract, is 41.38. That is your break even point. If it starts to break above 41.38, then you start to some of this $2 of risk. If it breaks above 41.40, then you're looking at your max risk being your loss, which is 200. Vice versa, if we're looking at 41.10 on the put side, we add $2 and 41.12. So really your break even point on this iron fly is 41.12 to 41.38. As long as it remains in between those two levels, you'll either be break even on the trade or you'll be overall profitable on the trade. Anything past those levels is where you start to incur your risk. And if you're past the long strike on either side, then you're looking at a max loss on the trade idea. So that is what you see there. Always happy to help out. Aaron is asking if we can look at Snap. Certainly. Let me write this down. Oop, my pen is not working for me there. So let me pull out a new pen. Oh, there we go. So let me write this down. The trading journal for today, Snap. And then absolutely, a lot to you, Rick. We can certainly take a look at Airbnb. I'll add that to the list too. And then T-Bird's asking, do I post my $500 trade alerts anywhere? Yes, I typically will post my $500 challenge trades here in the free room. I also share them on Twitch and let y'all know whenever I have an alert. I'll send out a tweet basically to let y'all know that I'm opening or taking action in the $500 challenge account to let y'all know to go over and check Twitch. I post them in the options room. Used to post them in the day trading room. That's now Trendy's John's room. So I am not going to do that anymore because I don't want to step on his toes. And as always, of course, I post all of my trade alerts in the Profit Recycling Mastery if it's involving the $500 challenge or the Mastery account itself. So I do post them multiple places. We've been a bit lighter this quarter on the challenge trades. One, because in general, I've been lighter on my trading. As I've mentioned, I'm a bit more of a directional trader. And so I haven't done as many directional trades just because the market isn't calling for directional moves, which is why you see me shifting gears currently going more into iron condors and iron flies to take advantage of. And the second reason why is because the $500 challenge this time around, at least for this start of the year, I'm actually doing it for the full quarter. So for those of you who don't know, I do a $500 challenge where I wish $500 each month and we see how much we can grow it. But I had some quarterly analysis and signals that I'm still watching to see if they potentially follow through or not. And because it was based on a quarterly setup, I decided that for the start of the year, we would do the $500 challenge for the first quarter rather than just it being month for month. That way I could put in one of these quarterly trade ideas and see if it could work out by the end of June. Starting in July, we'll go back to it being month to month though. So that should help out at least a little bit more on the frequency of the trades I put out there, especially if we can get back into a trending market again. Yeah, I apologize. I've gotten that note before on my Tasty being a little bit blurry. I don't know why that is. I'll ask Daryl and see if it's maybe the display. Keep in mind, for those of you that are over on the Simpler website, what you can do is up in the corner, and I'm sorry, this is going to look like slight inception here, so I apologize. But in the corner up here is a magnifying glass. And so you can always use that magnifying glass to zoom in and get a better read of whatever symbols or signals that you're looking at whenever I pull up Tasty Trade. Otherwise, I will ask Daryl and see what I might need to do to clear that up so it's not as blurry. But that is one way I know I certainly go about using it whenever I'm watching some of the other traders, and it's a little bit hard to see what they're looking at, especially if you are on a smaller screen or something. So I hope that helps you out. And you are saying the magnet. Okay, I'll ask Daryl and see what I can do to fix that. But somebody mentioned that yesterday in the room too, so I'll see if I can't figure out a workaround for it. In the meantime, though, let's pull up both Snap and Airbnb and see if there's any signal setting up there for a trade idea. Hey, OT, good to see you. Good morning to you. So starting off with Snap, let's have this load up here and we can take a look. Any second now. So on Snap, it looks like it's getting a nice bounce up today. Still, though, in a bit more of a bearish trend in regard to the moving averages. The 10 is below the 30. Both are below the 100. Momentum's in the process of resetting, so that makes sense why it's bouncing back up into resistance. We do have a bullish signal on the compound breakout tool. The last 2 days, we had 2 bullish divergent bars. So if you took a bullish trade idea off of that indicator, well done, because it got a beautiful bounce to the upside and follow through. So that should, depending on your strategy, right, should have allowed for a very nice quick win. Otherwise, though, you'd want to be cautious about playing this much higher. You're about to run into the 30 period simple and the ATR trailing stop. And like I said, the trend for the most part is still overall bearish. So until we can actually try and get a stronger move above the 100 period simple, you need to be very mindful of how the underlying price is going to act at resistance levels there. And Dole, I see that one, LRCX. I'll add that to our list here. We can take a look at it in a second. Let's pull up the weekly chart first on Snap, though, see if we're running into weekly resistance or anything. So on the weekly chart, We also have resistance above us with both moving averages right around 10. So that's not too far away from that daily resistance level. So if you are already in something bullish, don't hesitate to take your profits here. If you have the flexibility of multiple contracts to where you can leave a runner on, you certainly can. But I would say if you see any sort of stalling at or slightly below this $10 price level, in line with those resistance levels that we talked about on the daily as well as the weekly chart here, I would look to take the quick win. The reason why is, as we've talked about earlier in the session, this market's been very choppy, and all you're really wanting to do at this point is play from one level into the other. If it starts to break above 10, great. You can always re enter the trade idea and play it back up into the next resistance level. But if you stall at 10 and we start to reverse, you'll be much happier with yourself that you took the profit there rather than seeing your profit turn back into a loss, right? On the weekly chart, everything's still really flat with momentum. As you can see when we're zoomed in here, you barely see the bars. So that to me is more a sign of consolidation. However, we do see that the bars have started to cross back below the zero line. So that adds a little bit of bearish weight to it. We have a bearish signal in the compound breakout tool as well. And then, of course, we have a weekly squeeze that we've been building into. Now, personally, my caution about playing things like this to the downside is we're already at $9. So the question you always ask yourself is how much lower can it actually go? And of course, as we've seen with some of the regional banks lately, they can certainly go lower. But you still just want to be mindful of that perspective if you're trying to play this short to the downside, right? There's only 9 points of room to play lower until you get to zero, right? Versus there is infinity of amount of room to play this to the upside. So keeping that in mind when you're playing squeezes like this, that if you're really trying to play the squeeze to fire one direction or another, doesn't mean it can't fire lower, but it does mean that it's limited on the room to the downside that it has to go. And then let's pull up Airbnb up next. So Airbnb recently had earnings. I do know that. I think we talked about some earnings trade ideas. I can't recall if it was in here or in one of the other simpler rooms. But if you did take one of my trade ideas off earnings, the volatile trade idea, which is the one I normally go with, worked out beautifully. Um, Typically, we'll look at something like a call and put broken wing butterfly or a call and put debit vertical spread. Sometimes we'll just look at a long call and put if it makes sense from a risk tolerance standpoint versus the anticipated range of the move. I think in the case of Airbnb, if I remember correctly, we were looking at either the broken wing butterfly or the vertical spread, though. And as you can see here, we had a beautiful gap to the downside. And then just a couple days later, it continued to follow through lower. So this definitely would have been profitable on that volatile move trade idea from an earnings announcement. Now, at this point, if you're looking for a new trade idea, we are seeing a bit of consolidation here. So the price is looking to get back inside the second deviation Bollinger Band. You do saw a bearish weight with the momentum and with the compound breakout tool, certainly to be mindful of in case we do try and trend lower here. It could be that we first try and bounce up to test the 100 as resistance. That would be a much better entry to get on the short side if we bounce up and hold the 100 as resistance versus this level here. I'm not really inclined to put on a bearish trade at this time, given that we're nowhere near daily resistance, right? Daily resistance would make a much cleaner entry. We do still technically have a valid bearish divergent bar. So that's looking for a move back down to 104.30 within the next 3 bars. So that, given where we're trading at now, that certainly still has a pot try and get back down into that level. If the signal follows through, let's take a quick look at the weekly chart, make sure we're not running into weekly support. So if you got on the bearish divergent bar yesterday, then obviously this bounce up isn't what you want to see necessarily. From a weekly perspective, you do have the benefit of the 30 period simple trying to hold as weekly as a resistance level, so that's at 108.55. Um, Depending on how long you gave the trade and on your risk tolerance, you could always look to build in a little bit into the trade. So that way you kind of average down the price to then play it lower. But otherwise, the caution about this bearish divergent bar is that it wasn't near any sort of resistance when it was formed, right? It was kind of floating there near the lower Bollinger Bands. And prior to that bearish divergent bar that printed, you actually had a bullish divergent bar. And so when you start to get back-to-back divergent bars, sometimes that can be a sign of overall consolidation. So personally, I probably wouldn't have entered this trade, even though you did have some of the bearish agreement down here on the lower indicators. The downside on sometimes taking back-to-back divergent bars like this is that when if it does end up following through, sometimes it barely follows through with the higher, higher, lower, low before it goes right back into chop. And so I would just say be mindful of that. If we do get a move down to 104.30 and it looks like it's instantly stalling, use that to take your profits or to protect capital because it could just continue to chop here, allow things like the 10 period simple to catch up with the price. And then once that happens, then we might get a bit more of a directional move off that point, especially because like I've said, this market's been very choppy overall. So you want to be mindful of the consolidation that we've seen recently and how those back-to-back divergent bars can kind of play in line with that too, unfortunately. Um, just look here, see if it's kind of had it stall a bit there from a price level in the past, so that might give you a little bit of issue too. Um, so yeah, when I zoom back out, there's still a lot of room on momentum, so that does benefit for a more bearish move to still have a bearish trend move here. Certainly, if the data tomorrow comes in to where the market reacts negatively to it, that could help push the price lower as well. So there's still time. The bearish divergent bar, at least in my rule book, I give it at least 3 bars to work out. So it's still valid into Friday. Basically, by Friday, you would be looking to see if that follows through. And if it hasn't followed through by then, and you have your expiration further out in time, usually that's a place where I'll go ahead and protect profits and take it off the table. And then you can, of course, always look for a re-entry point. Yeah, kinda like a bear flag. See, my issue, Rick, with looking at things like, bear flags or bull flags or head and shoulder patterns is I feel like they're a little bit subjective. And what I mean by that is it's easy to look at something and if you want the market to move a certain way, right? It's easier to talk yourself into that possibility saying, "Yeah, this is totally making a bear flag," for example, or it's making a head and shoulders pattern. And it's that subjectivity that I personally am not a fan of because I've noticed it, and I speak from this from pure experience. So I'm not trying to pick on anybody or anything like that. I'm speaking because I've done this to myself, where I used to very early on in my trading career, I used to draw a lot of channel lines because I liked the visual aspect. It seemed pretty clear, like, oh, this is a bullish channel, it's a bearish one. But then I found myself almost talking myself into certain channels like this could be a channel or this could be a channel or maybe this is a bigger channel and this is a smaller channel trading in the bigger channel. And so it can start to get really subjective to where you're talking yourself into potential trade ideas because you want what you put on the charts to be right, right? You want the bear flag to be right. You want the head and shoulders pattern to be right. You want the support and resistance of your channel line to be right. And in turn, I found myself losing a bit more money on that because I kept hoping that what I was putting out there was correct rather than following what I would say are, the real line in the sands in regards to technicals like Bollinger Bands, moving averages, where it's all based purely off data to what you see hold as support and resistance. And so that's, my 2 cents off that. Now, there are other traders here at Simpler, like Chris, for example. He does a lot of things around bull and bear flags, and he seems to have a real great eye for them where he can kind of see it on the chart, call it out, and it works well in his favor. So it's not something that I'm like knocking, right? If you have a eye for seeing those things and you are good at not talking yourself into a trade, then by all means do whatever's working for your account, right? Do whatever is helping you grow it. But personally, I found myself talking myself into too many trades because it's just a little bit too subjective of a narrative to where it's easier to talk yourself in or out of something rather than just following what I see here on the charts as a very clear, oh, 100 period simple. That is clearly trying to act as support. And now we've broken it to where it should act as resistance. And I hope that makes sense. Dr. Bob, certainly. We can look at PA and W. Add that to my list too. And then am I seeing a 15-minute squeeze fire long on SPX? Let's pull up the 15-minute chart here. I don't have that on my intraday chart, so let me go back up here to my main chart and we'll pull up the 15-minute time frame. I will tell you right now though, the issue that if the squeeze is attempting to fire long, the downside is the 4140 level. I can zoom out here. It will probably show you on the 15-minute chart too. But since arguably about May 3rd, right? We have seen 4140 to 4150 kind of act as a price resistance level. So if we are attempting to see a squeeze fire to the upside, it could just be that it's going up to test that range, it stalls and it reverses right back down, just because that's what we've seen for the past 10 or so plus days. Now, certainly on the 15-minute looking bullish, right? We have Bollinger Bands opening to the upside, bullish momentum crossing above the zero line, bullish signal on the compound breakout tool. We have a squeeze. So I would agree, all of this normally I would say looks good to jump in to play for a run higher, but I would still be very mindful of those levels we talked about because you can see back here 4140 held as resistance here, tried to break a little bit above it, but ultimately held back here. Same thing happened here. We tried to break a little bit above it, but then it held. And then same thing happened back here too. So you can see between 4140 to 4150 in that range, we have quite a bit of price resistance that has caused a bit of a hiccup for the underlying price. And in turn, you can see how sometimes it looks like things could get going and it doesn't. And basically that squeeze in turn just keeps printing and building up energy. So I do think it's a possibility we could go up and test those levels given the nature of this chart, but I probably myself wouldn't look to play past those levels until it proves that it's breaking them. Otherwise, I would just be looking at it for a quick scalp move overall. And, Rick, first of all, happy that you took his class. In regards to mixing up styles and analysis, I wouldn't necessarily consider that a bad thing, right? I think that there are a lot of traders here just at Simpler who have taken, strategies or indicators from some of the other traders and then have meshed that together to create their own trading style. And I think that's the best thing you can do as a trader is not to follow somebody just word for word flat out, right? Or alert for alert necessarily, but to see what really works best for you because we all have different personality types. We all have different things and ways that we can analyze a chart from either a macro point of view or from a technical point of view. And so I have found personally the best way to go about it is to pull things that I have found useful to myself in my trading career and what's helped me grow my account, and then mesh that together to create my own trading plan and my own trading style to what works best for me. So I don't think there's anything wrong in necessarily mixing up the style and analysis. It's just, um, trying to match it together to what actually is working for you and your account. And if you do not have a trading journal, I certainly suggest keeping one, whether it's handwritten like mine, whether it's, on an Excel spreadsheet, however you go about it, doesn't really matter, but still make sure you take one and keep one because that way it's much easier to then go back in your notes and say, okay, what trades worked for me? What didn't? What was the reason why I jumped into this trade, right? Was it based off a certain indicator? Was it based off, a bear flag? And then that way you can really see what's working for you and what's not. And also, Just as important, see what's working in the current market environment that we're in. So that way you're not making the same mistakes over and over again that's hurting your account, and you can flush it out to where you're going through what is working for your account and looking to repeat that process until it proves otherwise, right? Until we maybe go back into a trending market or something like that. So I don't think there's anything wrong with doing that personally. I think that's a good way of going about things, but keep track of what's working and what isn't. That way you don't keep falling back into the same mistakes over and over again. So for example, if you see a bear flag, but you see back-to-back divergent bars for chop, that might, in the future maybe give you a pause, or it might tell you, okay, it worked out last time, but it just took a bit longer to work out. So I need to give myself more time on the expiration to play for the bearish move, right? Things like that. So that way you're not falling into the same pit holes every time you're putting on a trade because you're not learning from your past mistakes. So after that quick look, let's go on to LRCX, and then I will still pull up PANW. Absolutely, Dr. Bob. And then CJ, good to see ya. Absolutely, we can take a look at DDOG. We should have time for that. So on LRC, if I remember correctly, this is more bullish. It is. So beautiful move to the upside. This is actually getting a trend move. We've broken above the high that we had earlier this year back in February. We've certainly broken above this price resistance level that we had back here around 536. Bollinger Bands are flaring open. There's plenty of room on momentum to continue this bullish sentiment to the upside. Our daily squeeze appears to be starting to fire. So keep in mind, when a squeeze starts to fire, usually, if I remember correctly, it can last like from 5 to 8 bars, continuing that strength of the move. So because it's just starting to fire, that means between that and momentum still having room, there's probably still room to the upside on this move itself. The downside for somebody like me is this really isn't a good place to jump in at, right? Back here near support levels where it was holding the 10, much better entry to then try and play this long. Or even on this bar here, once it proves that it was breaking price resistance, much better entry to then play for the follow through. It's not making a third deviation Bollinger Band snap. So that's when the price exceeds this outside blue line, which is the third deviation Bollinger Band. When that happens, usually that helps basically keep the price either within this range or going. But unless it, bounces up again and it moves past the high of the day, it's not it didn't quite print that, right? So the caution here is the price is currently outside its comfort zone. The comfort zone is the second deviation Bollinger Band. So unless it gets a really strong move to also exceed the third, you need to be mindful of a potential pullback, right? To get it back within the comfort zone, if you will. Let's take a quick look at the weekly. There is a weekly squeeze that's still valid. Let's make sure we're not running into any weekly resistance. So weekly resistance, we're actually just starting to break above the 100. We have bullish momentum, still room to move higher, bullish signal on the compound breakout tool. There's that weekly squeeze that's still valid. Um, do have a little bit of price resistance we're about to run into. So that might, if you're already in a bullish trade, might tell you to start locking in some profits along the way if you haven't already. Otherwise, though, I would say the bigger level I'd play into at this point is 575 is going to be a mini psychological level, but if we manage to break above that, 600 would be the big level to play into, both as a psychological level as well as a price level, which would allow for about 20 to 30 more points to the upside. So I think it looks good. It's just personally for me, it's not the place necessarily to jump into a bullish trade at this time. I either personally would prefer to see a pullback or consolidation into support. And if support holds, right, make that my entry. And it did my arm to make me jump into a trade here. What I would say to do is please, please, please consider doing a smaller capital risk than you normally would. That way, if it keeps going, great, you're in a trade. But if it stalls or it pulls back into support, you can either one, build into your normal risk tolerance. So let's say your normal risk tolerance is $500 per trade. Well, if you are entering here, maybe only start with $100 of risk. That way, if it pulls back into support, you're able to build into the remaining $500 of risk tolerance, aka you could put 400 more dollars into the trade, but you're doing so at a much better price level, at a much better technical level than to do so up here. And then, of course, if we pull back and we start to break support and that narrative changes, you'll be much happier managing only $100 of risk versus managing $500 of risk from up at this level here. So if you really were trying to force a trade on when it's already started to move, I would say just keep your risk on the smaller side if you were to do that. Um, and then so that's what I see for me. It's not a place that I could jump into a trade, but if we get a pullback or consolidation into support and everything still looks valid, more than happy at that time to then take an entry. Let's pull up PANW. And then Earl's asking, to what extent would you interpret the outperformance of the Russell today as a potential leadership rotation? It's funny you say that because I think the Russell is actually the weakest out of all the indexes. So we can pull it up and take a look at it. But in regards to like from a daily chart perspective, the Russell, if I remember correctly, is the only one trading below its 100-period simple. SPX is still trading above its 100-period simple on the daily chart and trying to keep a bullish trend. NDX absolutely still has a bullish trend around it. I haven't taken a look at the Dow recently, but if I remember correctly, that one is still pretty bullish. But RUT's actually been on the weaker side of everything. So if anything, actually, it was looking to move, if things were starting to sell off, the Russell would be, I think, the one to go first. But I'm happy to pull up the chart here in a second. As for PA and W, earnings is the 23rd after market. So what day is the 23rd? Of Tuesday. Okay. Well, for those of you who aren't aware in the free room, I do a market update on Mondays. I don't usually post it in the free room because I think somebody else is technically on at that time. But I do that both over on my Twitch channel and on the simpler YouTube as well as in the profit recycling room. So if you're really interested in an earnings lotto trade to play through the announcement, remind me on my Monday morning market update, and I'm happy to walk through a trade idea. But as of right now, it's a little bit too early for me to jump into an earnings lotto trade to play through the announcement because there's still a lot of time left until that news happens. So we might be trading at 200, right, when we get closer into the date, or we might be trading at 180. And that would kind of change the narrative of what I'd be looking at for an earnings trade. As for what could happen going into the announcement, I think it's very likely that will chop, as much as I hate to say that. But Bollinger Bands are flat. The 10 and 30 are converged. Momentum's kind of going back towards that zero line. This is more of a pullback signal on the compound breakout tool. And we've seen a lot of things this earnings season where if they can't get necessarily a run up into earnings, usually they end up chopping going into the announcement. Now, just off the top of my head, if you're forcing me to look at an earnings trade today, here earnings had a gap to the upside. Here earnings had a gap to the upside. Here earnings had a gap to the upside following the announcement. And here we had a gap to the upside. So, I mean, the last four earnings have been more on the volatile move side of things. So I'd probably look to do something similar to what we talked about in Airbnb, which is you either look for two broken wing butterflies, one on the call side, one on the put side, or two debit vertical trades, one on the call side, one on the put side. I would not put this trade on now. I would wait closer into basically the day of earnings. So Tuesday, because it's going to be after market hours on Tuesday. So I'd go in Tuesday's trading day and look to put on the trade then. But I would look to play for more the volatile move with the idea of I don't know if it's going to bounce up or down, but do know that there's a good probability of seeing volatility after the announcement. And if that happens, then I have something set up on both sides to either take advantage of a volatile move up or a volatile move lower. So, in short, that's how I'd look to play it. Dr. Bob, I hope that helps you out. Of course. And like I said, if you're on in one of the rooms that I do my Monday morning market update in on Monday, remind me and we can definitely take a closer look at actual strike levels and things like that to work through for that trade idea. D Dog was up next, and then we'll pull up the Russell here as probably the final thing that we look at for our session today. So on D Dog, CJ, this is a great run up. Are you in this? Because if so, well done. Here's a really good example of what I meant by the third deviation Bollinger Band move. So here, for example, off earnings, we had such a strong move that not only did it break the second Bollinger Band, the second deviation Bollinger Band, but it also broke the third deviation Bollinger Band. And when that happens, it basically it my guess is it causes almost a case of FOMO, right? Where if anyone was wanting to be bullish and they weren't, they see the move and they're like, "Oh my gosh, I need to jump in," right? Like a case of FOMO. And on the flip side, for anyone who was short and sees that kind of move up, they're like, "Oh my gosh, I'm losing money. I need to protect capital." And so they start closing out of the short side. And in turn, people closing out of their shorts as well as people buying in causes that bullish move in this case to continue. And so you can see the next day we actually made a higher high, another third deviation Bollinger Band snap. It did pull back into a bearish divergent bar, but personally, especially with momentum being so low and the squeeze being valid, that would not be a signal I would take. It did technically follow through with a lower low, but it barely followed through with a lower low. It stayed within the same trading range, made a bullish divergent bar, didn't get the third deviation Bollinger Band snap, but we still continued that bullish sentiment. And that's because of what happens here. So if you ever see a third deviation Bollinger Band snap like this, there's a good probability that the underlying price the next few trading days will either stay within this current bar's range or will, in this case, because it's on the upper Bollinger Bands, continue in the bullish narrative to the upside. And you can see this one's continued in that bullish narrative. The squeeze started to fire, still a valid signal here. Momentum's bullish, but I will say the thing to be mindful of is we are definitely at the top of the axis. So you need to start being careful of exhaustion. Um, you're not CJ. Yeah, I wish I was too. This was a really nice move. I was not watching D Dog off of its earnings necessarily to trade it. Um, Bollinger Bands are flaring open to the upside, so they're still anticipating move higher. The 30 is about to cross above the 100. So all of this adds to the bullish aspect. But the one thing I'm not a fan of is how high momentum is. If you start to see some red bars print, that's a good sign you're getting exhaustion. And exhaustion typically means that we will either start to consolidate or we could see a pullback in the price. So that way momentum can reset before the next trending, whether it continues to the upside or it drops back down lower. Um, but it certainly doesn't seem like a bad move. Let's look at the weekly chart really quickly and see if we're running into weekly support resistance. It's definitely not a place I'd jump into a new trade because one, the squeeze is already fired and we've seen the follow through on those bars. And two, it's still not near a support level on the daily chart to make for a cleaner entry to jump back in on. If you are in this trade, then you might actually start consider protecting profits because we are about to run into the ATR trailing stop that's at 94.03. So if you start to see the price hit that level and stall, or if it starts to stall slightly below that level, consider locking in the win. Worst case is you take the profits, it starts to break above it. Great. You can always then look for a re-entry to play up into 100 or to play for a move into the 100 period simple on the weekly chart, which is at 112, right? And play for that trending move and maybe the weekly squeeze to fire to the upside. But personally, like I said, just given how this market's been, I'd be very mindful of this resistance here that we're seeing overall. Oh, not what I meant to do. Daily chart. And then last but not least, let's go over to the Russell RUT. Of course, CJ, not a problem. So here's the wrestle. It is certainly, I see what you mean by outperformance today. It's getting a very nice solid bounce to the upside. And it is that price support. So I was actually looking at this one the other day for a potential bearish trade, and I didn't take it. And of course, now looking at the bounce up, I'm very happy I didn't take it. But part of the reason I didn't take it was because of price support, right? You can see right here, kind of similar to SPX, where recently we have done a really good job of holding around 1730-ish as a price support level. And so even though it looked like we could start to roll over yesterday, we were still holding that level into the close. So you always want to be mindful of price support and price resistance because sometimes those will beat all the other technicals and remain valid. And in this case, it did, right? It beat the bearish momentum, the moving averages, and now we're starting to bounce back up. The downside on this bounce, though, is we're running right into price resistance, right? Play from one level into the next. And price resistance is also kind of right in line with the 30 period simple um, at where is that number? At 1763.67. So we're just still slightly below it. Momentum is still technically bearish for the day. It's below the zero line, so that adds a bit of bearish weight. We have a choppy signal on the compound breakout tool, so that's consolidation. And as you can see here on the daily chart, this is what I was talking about. It's still trading below its 100 period simple. So if you asked me in general what the weakest out of all the indexes look like, I would say RET looks the weakest because it's still below the 100. It's still actually in a bearish trend compared to the other indexes. Um, but that being said, it might be finally trying to find a bottom here, certainly, right? 1700 is kind of the lows that we've seen for the year that's been holding. But even though we are starting to try and get a slight bounce, we're not really breaking out of this choppy pattern. And even if we do manage to break the 30, I'd probably only play it up into 1800 as the next target to the upside, maybe 1810-ish up into the highs that we had here. That'd also not be too far away from the ATR trailing stop and the 100 period simple around 1815 acting as resistance. Notice also the Bollinger Bands are still more in consolidation. So at this time, they're not anticipating a break one way or the other. They're anticipating still chop at this point. So this is exactly what I mean by playing one level into the next. If we keep stalling here, certainly if it pulls back down into the close, there is news out tomorrow. So still be mindful of any overnight risk that you put out there. But I'd almost be inclined to then look to short it with maybe a call credit spread or a call unbalanced butterfly to play back down into the support level. That way, if all it does is stall, right, the credit spread will benefit from that theta decay to lock in a profit. And if you get the directional move lower, then it should certainly be a profitable trade overall, depending on where your short strike is. So I hope that kind of helps you out, Earl. But that's what I'm seeing there. And that is my time, guys. So thank you so much for joining me. As always, may the trade be with you, my fellow Jedis. We are starting to get closer to 4140. Notice on the hourly chart, we are starting to get some bullish signals, but the Bollinger Bands are still flat. So doesn't mean we can't push higher. If we do 4147 to 4150 would be my next target from an intraday perspective, but also be very mindful that we could start to stall here because this is the same price level that we have continued to stall at in the past. So if we get actually going in a trending move, maybe we can get going somewhere. Otherwise, though, we could very well just stall here, and this might actually be a place to start looking at a counter trend trade to play for a reversal move back to the downside. So be mindful of that. Um, and I look forward to talking to y'all again next week. Have a great rest of your trading week. Bye, guys.